Good afternoon, everybody, and welcome to this special webinar that I'm doing here with Scott Nations of Nations Index. And I'll let him explain what he does to those of you that aren't familiar with it. But just a quick mention. So, what I'm looking at right here is a little volatility panel that I have, and there's S&P over here, and I have a few of his indexes on there that I look at all the time. It's kind of part of my daily routine, and specifically SKUDEX, which is one standard deviation out of the money, 30-day SPY put demand, we can call it, and TDEX, which is three standard deviations. And we actually had a very nice trade on Monday, and we saw the setup coming on Tuesday, Wednesday, as demand for tail puts started coming up and ramping more than demand for the one standard deviation out. Vol I, which is the at the money, kind of went up a little bit, kind of commensurate with VIX. And that looked to me, and I don't know if I interpreted it 100% correctly, but my intuition told me that was short-term people reaching for tails just in case after the tariff stuff and after the FOMC, and that in my world, I'm waiting for that to be fumes. I'm waiting for that to provide decay, for hedging up. And then we had the VIX spike peak over here. Over here, where was it? We had the VIX spike peak over here. Then VIX came down, and that kind of set this up. And I was just and we had the VVIX pop. And so anyway, I'm going to turn it over to Scott, but I'm going to start off with a question. I happened to notice on Twitter that he tweeted out about call decks out of the money. And if you could kind of start off with that and explain to the folks what that is and kind of take it from there.
Sure. Thanks, Doc. Quickly, I spent 25 years as a proprietary option trader on the floor of the Chicago Board of Trade, trading options on Treasury futures, and on the CME, trading options on S&P futures. And as we became more electronic, we realized that we needed metrics that we could use internally for our own prop trading that would help us understand the markets better. And out of that grew the nation's indexes business. So we created some really interesting, helpful indexes, and we now calculate them in cooperation with SpiderRock. We calculate them on all of the big and or important underlyings in finance and American finance. So quickly, our five flavors are Voldex, which is closed form solution of precisely at the money, precisely 30-day implied volatility. So Voldex, precisely at the money implied vol. Calldex is the normalized price of the one standard deviation 30-day expiration out of the money call option. Putdex is the same for puts. So one standard deviation out of the money put, 30 days to expiration, normalized price, so it's apples to apples, regardless of how expensive the underlying is. And you might be thinking, boy, that would be kind of an interesting relationship, put dex versus call dex. We think so too. That is risk dex. Risk dex is simply the ratio of put dex to call dex. Call it risk dex because that's a risk reversal trade. And finally, a really interesting index that we get lots of questions about is tail dex. Tail dex is the normalized price of the 3 standard deviation out of the money put, 30 days to expiration. And we call that tail dex because that 3 standard deviation out of the money threshold is the beginning of what's considered a tail event. And tail dex is interesting because tail events are much more common in the stock market than you would expect. If stock market returns were normally distributed, you would expect to have a tail event on a monthly basis about once every 667 months. and in truth, they happen about once every 30 months, and so much more common than they should be if returns are normally distributed. So that's a really interesting index as well. And we calculate all those on the S&P, the NASDAQ 100, the Russell 2000. Just started calculating all of them on the emerging markets index, as well as fixed income. So high yield bonds, treasury notes, gold, silver, and then a bunch of single names, all of the big single names and the interesting single names. So NVIDIA, Tesla, Apple, like that.
Want to share your screen and show some of the stuff?
Yeah, let's take a look at some of this. So all of our indexes are available via subscription service at nationsindexes.com. And here you can see Voldex, which is, again, precisely at the money implied vol. You can see it on the important underlyings that we calculated on. These are the broad asset classes. So, and that includes Bitcoin. Bitcoin Voldex has been really interesting. So that's Voldex on the big names. And this is where it gets interesting, Doc. You mentioned this earlier. This is Caldex. So normalized price, 1 standard deviation out of the money calls. And look at this. So volatility in the S&P 500 is down across the entire skew with the exception of these out of the money calls. They're actually higher on the day. Same is true in the Russell. So this is why we say deconstructing skew is so important to understand what the market is really telling you.
So would we hypothesize this is right tail hedging? Well, how would you think about it?
And well, let me because we're talking constant moneyness. So always exactly 1 standard deviation out of the money, always exactly 30 days to expiration. And that's updated every 15 seconds. So this is not a function of market movement. This is absolutely sticky delta.
Okay.
I would say that there are some people who are reaching to buy S&P calls as the S&P itself is up 48 points today, nearly just over 0.75%. I think people in the S&P are reaching to buy calls because they want bullish exposure. Maybe a little bit of stock replacement, buying calls for stock replacement. But I think I think people just, they want to buy calls. They think we're going to the moon, so they want to buy calls. So I think that's what's going on here. And we can look at some of these for a longer time frame. And one final, before I get too far. Doc, I appreciate you having me on. And I wanted to do something for all of your listeners. So my first book, my third book, actually, History of the United States in 5 Crashes. If everybody will send their estimate of where the S&P 500 is going to close this week, what's the closing tick? Whoever sends that to us via X, I still call it Twitter, at nations_indexes, whoever's closest in percentage terms, I will send them a free signed copy of that book. So be sure to check with us at Twitter. But let's look at some of these indexes on a longer time frame. So we've been talking about Caldex. Let's look at Caldex.
Now, Caldex isn't available for me in like TradingView or whatever. I only have a few tickers that I can play with.
That's right. Caldex is one of the indexes that's available only via subscription, and we only offer a few to the general public, just for free. So, but Caldex on all of our underlyings is available at the subscription service. Again, nationsindexes.com. So, and Doc, this is probably another reason that we're seeing Caldex on the S&P climb a little bit today. Here you can see the 52-week chart for S&P Caldex. And you can see that it's gotten really low, So I think there are also people who see out of the money calls in the S&P being really cheap things looking pretty good in the market, and that's another reason that they're willing to kind of pay up and get some exposure.
Right. Or even when we had that tail event kind of a couple days ago, well, gee, the puts are expensive, the calls are cheap. I can sell puts and buy calls.
Right, right. And RiskDex is a great measure of that relationship. Let me see if I can, let me share this again real quick.
And then the other thing that a lot of people are talking about this, you could call this sort of the most hated rally. There's no reason for us to go up. So, and a lot of people, from what are not long or have lightened their exposure, and so this is a way to have a right tail.
Yeah, and look, if you look here at RiskDex, so S&P 500 RiskDex 3.71. So out of the money puts are nearly 4 times more expensive on a normalized price basis than out of the money calls. So maybe we should be buying some calls to get a bullish exposure. Maybe that's the way we should express our point of view. And I think that's part of what's going on.
Makes a lot of sense.
Yeah. And when RiskDex gets to an extreme, one way or the other, then that's when we find a lot of people putting on either collars or they put on risk reversals.
Now, you mentioned extreme, and I know you've got the metric with the 10%, 50%, 90%, whatever your percentages are. That would be interesting to show people because that's a very user-friendly, handy way for how to look at it.
Yeah, that's, one of the reasons that we do this is, and I just want to make certain I'm not sharing anymore, right? No, not sharing. Yeah, the reason that we calculate all of our indexes is because it's too often people have been trading with a hunch or intuition or something like that, rather than having some sort of objective metric. For too long, people have been relying on their memories. Oh, well, these calls seem kind of expensive, or oh, these calls seem kind of cheap. And rather than do that, because we know that we trick ourselves when we do that sort of thing, we created objective measures. And here we go. If I can, let me share my screen again, and we'll put this one up.
And while you're doing that, everybody that's watching, put questions in. I'm sure you have a bunch, and Scott will be happy to answer them.
Yeah, I always love the Q&A portion when I get a chance to talk to people. So, and here you can see the important metrics for all of our indexes on the S&P 500. So all of the 30-day measures, we started calculating them in January of 2005. 7-day measures we started more recently, 2013, and that's only because that's when there were enough expirations listed in the S&P world that you could start calculating 7-day measures. But here we go. On the one all the way on, we're on the left is S&P 30-day Voldex. You can see the average is 17.14, and right now it's quite a bit lower than that. Median, of course, the median in a volatility space is going to be quite a bit cheaper than the average. But then you can see some important percentile levels there. And again, this is objective now. So you can look at the current number for Voldex and compare it to these percentile values. And if it's, say, below the 25th percentile, okay, it's low. Below the 10th percentile, yep, it's very low.
But so if it's low, what's the trade? So what's the trade? If it's low, what's the trade? In theory.
Well, if it's low, then from a trader's point of view, you want to be long.
Right.
The only caveat is you have to look at the calendar, even in something broad like the S&P. everybody hates to be long volatility in August. So if it's low, and it is now, let's see, right, 1346 right now. So that's below the average. It's even below the median. I would generally want to be long when vol is cheap. I don't want to be short vol when vol is cheap and rely on it getting even cheaper. But again, you have to look at the calendar again. There's a reason that options get cheap during August, and it's because not too much happens. So, and that's why we created our indexes, and that's how we use them ourselves.
Okay, so let's talk about, you mentioned TDEX, and let's talk about the ones that are sort of publicly available so that people kind of, see them on their TradingView or on their Thinkorswim or wherever it is, and how to use them, how to think of them. And like I said before, TDEX and SDEX are ones I kind of look at all the time and just sort of use my own way of looking at it. What are market participants doing, and how is that going to spill over into the S&P and into the vol space in general, and where might I get an inflection point? And like I said, when I see TDEX starting to turn up, that's a danger Will Robinson sign. But then when I see it kind of peaking, and I don't really know what the average metrics are, but just kind of looking at a chart, let me make it a kind of longer time frame. When I'm looking at a chart, I'm saying, this looks extreme. This kind of looks like normal fear, so to speak. And this looks like, okay, we've gotten over our skis.
Yeah. So again, we'll take a look at this metric again. There we go. Voldex on the S&P is publicly available. Ticker symbol Volley, VOLI. Taildex on the S&P, ticker symbol TDEX for Taildex. That's publicly available. And then one that another one, SKUDEX, ticker SDEX, which we don't cover on here because we don't calculate it on all underlyings for some kind of market structure reasons. SKUDEX, SDEX, is the premium, the extra premium demanded for, in implied volatility terms, for 1 standard deviation out of the money puts. So it's
okay. So hold on, the extra premium. So this isn't just 1 standard deviation out of the money. It's like 1 standard deviation with a twist, so to speak.
Well, it's always exactly 1 standard deviation out of the money, but it's it's how much more expensive those puts are in implied volatility terms than the precisely at the money puts are.
Okay, got you.
So, and that's how we in the equity index world have always measured skew. There's no consensus way of how to measure skew, but that's how we've measured it. So that's how we look at it. So those are the 3 that are publicly available to anybody. Here we go. Anybody with any, just about any data provider, TradingView, Thinkorswim, Schwab, Google Finance, Yahoo Finance. And again, what we do is our approach is generally we want to own what's cheap. We want to short what's expensive. When it comes to shorting options, we would always suggest defined risk structures. So we would never suggest selling naked calls, but we would suggest selling call spreads instead.
Speaking of which, yesterday you told me something about AMD that you had noticed. Maybe you want to share that with the folks.
Sure. And we talked about this in our newsletter, weekly newsletter, Volatility Insights. If you go to the website nationsindexes.com, you get a chance to sign up for a free weekly volatility insights newsletter. And a couple weeks ago, we started talking about AMD because, well, everybody loves it. That's certainly true. But another reason we started talking about it was because we love to look at our indexes, particularly on the single names, and combine those with measures of momentum. So a couple of weeks ago, we pointed out that AMD, and I'm going to bring it up right here. A couple of weeks ago, we pointed out that AMD call decks had gotten really expensive. And I'm going to share again. Here we go. So a couple weeks ago, we noted that AMD call decks had gotten really expensive. In fact, it was at about the 65th percentile of its 52-week range, which might make sense for, a name that everybody was loving, AI name. They make those chips. But the interesting thing was that not only was call decks really high, but the stock itself was overbought. So relative strength index for AMD a couple weeks ago got well above 70, and until today was spent a lot of time recently above 80. And so we said that's a perfect setup for a covered call. And we suggested selling the August 15 185 call as a covered call in AMD. So again, intersection of call decks being very high, meaning out of the money calls were very expensive, and the stock being overbought. That's just a really sexy setup for us, and that trade has worked out really well for anybody who followed it. Stock's up a tiny bit since we would have put that on, so you made money there. And those calls have now collapsed post earnings, so you would make some money there too.
I don't know if you can see the questions on the screen here. We have a couple of questions. So can you see it? Can you read the screen there?
Let me take a look.
What single name stocks and other indexes have nations data available was one question.
Here we go. Oh, that's a good question. So let me here we go. And I will present this. So as far as what we're going to call broad asset classes, we cover all of what we consider all of the major ones. And you can see them there. In the equity space, S&P, NASDAQ 100, Russell 2000, and the emerging market equities. In fixed income, treasury notes, treasury bonds, as well as high yield bonds. Although I will say this, high yield bond implied volatility is really goofy. So while we calculate those, it's tough to separate the signal from the noise there.
Well, the whole bond market is goofy to me, but
yeah, you got a point, Doc. You can see precious metals and crypto, gold, silver, and Bitcoin. And Bitcoin's really interesting. And then you can see the single names that we cover. And I do believe that is, that's all the single names that we cover right now. So all of the Mag 7 and all of the 10 biggest in the S&P, and all of the interesting ones. So including Broadcom, AMD, which we've already mentioned, Nvidia, Tesla. Got to get a lot of interest in Tesla. So those are the asset classes that we cover right there. And we're adding more all the time. And if somebody wants us to add something special or something in particular, if you think that we're missing something, we'd love to hear from you. We'd love to add something if there's something we should really have. We're not too constrained. We could add more. The goal is just to add ones that will be helpful for users.
Now I remember, a few months ago I was on your website, and I forgot what the exact thing was that I was looking at. but I was kind of looking at a difference between Vali and Caldex, and I was kind of like comparing a few of the different ratios, the
Mm-hmm.
different indexes, and I don't remember the trade now. It was just 3 or 4 months ago, whatever it was, and it just kind of spoke to me. Can you talk about how you looked, how one might compare the different ones to kind of come up with a thesis?
Sure. And I see we have one good question. We have a great question from Wanted. I'm not certain how Wanted came up with that username. I'm not certain. I want to know. But for example, on the website, we offer the sorts of metrics that we just saw for the S&P. We offer those for all of the underlyings. So let me show this one. Here we go. Let me share my screen again. So for example, here you can see average, median, and important percentile levels for all of our indexes on NVIDIA. And again, we offer these for all of our indexes for all the underlyings we cover on our website. So this will help Wanted understand what is cheap and what is expensive. So we like to put it this way. So for example, let's look at NVIDIA risk dex, which is again just the ratio of put dex to call dex. The average is 1.21, median 1.20, and you see the important percentile levels here. So if risk dex was below 0.97 and anything below 1.00 indicates call skew. Calls are more expensive than puts. So anything below 0.97, which is the 25th percentile, we would consider that low. Anything below 0.82, which is the 10th percentile value, we would consider that very low. And then you can see 75th and 90th percentile levels. And above there, we would say high and very high. And
Now,
again,
how often does that happen for something like NVIDIA?
call skew.
The the risk desk looking like that. I mean, call skew I would expect.
Well, let's bring it up. Of the 10 biggest names in the S&P 500 right now, only one of those names is showing call skew, and it's only Tesla.
Of course.
Only Tesla is displaying call skew right now. So we'll bring up this chart really quick. Try to be really quick. So only of the 10 biggest names, only Tesla is showing call skew, and we also post these values on Doc. I still call it Twitter.
I still call it Twitter too.
Yeah. And we post these occasionally. Joe and his team post these on Twitter occasionally. What we have found out is that when the 10 biggest names in the S&P 500 are showing, when several of those are showing, here it is. Sorry, it's taking me a while. I have a lot of data to go through. When those names are showing, when a lot of those names are showing call skew, that is really a contrarian indicator.
Right.
So that's something that I think people want to watch for, is a lot of skew or a lot of names showing skew, call skew anyway. That's a contrarian indicator. So there you can see risk dex on NVIDIA. And again, this is just out of the money puts divided by out of the money calls price wise. And you can see that up until things got kind of ugly, started to get ugly in February and March of this year, it was common for NVIDIA to be showing call skew, and it's not doing that anymore. And that's important. So people can take advantage of this. Traders can take advantage of this. How would you take advantage of it? Well, as risk dex gets higher, puts get more expensive relative to calls, a risk reversal can make a lot of sense there. particularly if you want to have long exposure to NVIDIA, then a risk reversal is a great way to do it. You have to be willing to buy the stock if it's below the strike price of the put at expiration. But again, you wanted long exposure, and Doc, the beautiful thing about options is not leverage. Everybody falls in love with leverage when it comes to options, but we look at it very differently. We think that the beautiful aspect of trading options is not the leverage, but it's that you can create absolutely unique payoff profiles by combining options, option spreads, options on the stock. You can create absolutely unique payoff profiles that are preferable to simply owning the stock and making $1 if it goes up $1, losing $1 if it goes down $1. So that's where we think the real power in option trading comes from, is unique payoff profiles that are superior, rather than just rolling the dice, me and long the stock, short the stock.
And using these indexes would be one of the ways to come up with the payoff profile, of course.
Yeah, it's for us, it's a way to quickly identify potential trade structures that make sense. The AMD trade was a perfect example of that. Call index was very high, and the relative strength index for the stock was very high. Well, that's something we're really going to pay attention to. We're really going to look at it. That allows us to really focus our attention on potential trades that we think make a lot of sense. So that's how we look at cheap and not, is by looking at those metrics.
Now, somebody's asking if you provide futures. I think the answer is you don't, but go ahead, you can answer.
No, we don't. We do not provide futures on our indexes. It's not for want of trying. The SEC, the rules and laws of the SEC prevent it. So it's not just that the SEC makes it difficult. Absolutely verboten as far as the SEC is concerned. So we would like to, but we don't.
Now, I don't know if this is the way I'm supposed to use it, but sometimes I do this anyway. Right here is S&P, and let me. My mouse is getting stuck. Where's my mouse?
And AE, we would if we could. So just so you know, nobody is more disappointed than we are.
Okay, here we go. So right here, we see S&P topping out up here, right? And when I see that, and I know that there's short calls up there, this is was the final destination. This was also the top of the expected move in the morning when I looked, et cetera, et cetera. So not a shock, but for confirmation is the move may be done. I see the little turn in TDEX. I don't see it in VVIX. I don't really see it in VIX, but I see it here. And that seems to, I don't know if mathematically it's supposed to, but that seems to be something that when I notice that, it gives me a little edge.
Yeah, I think so. Again, the goal for us initially was objective data that allows you to trade, again, with data rather than hunch or intuition or, boy, that seems high, or boy, that seems low. I hope my memory isn't failing me, or that sort of thing. And again, because we deconstruct skew and provide data on all of the important segments of the skew, deep out of the money puts, out of the money puts, at the money options, out of the money calls, you can look at all those in concert and see, we talked earlier that vol is down across the board except for call decks. Well, that tells you something. And it's up to traders to incorporate that information into their thesis and come up with the best trade structure based on this insight.
Okay, and just as I'm looking at the comparison, we see TDEX turning up, But where's Vali? We don't see it turning up on Vali. We don't see it turning up on SDEC. So obviously, that means people are reaching for these out of the money puts just a little bit, these three standard deviations. And so the next thing I'm wondering is that going to eventually be fumes to send us up? Or is that a harbinger?
Yeah, and that's a great question. We have found that there are a couple of interesting things about the TDEX dynamic now. Um, eh, People have rushed in to buy every dip for the last, I don't know, 2 or 3 years. And the corollary of that is people have rushed in to sell volatility every time market recovers or falls and then bounces, recovers. People rush in to sell volatility and they rush in quicker and quicker and quicker every time we go through one of these cycles. So what we've seen is,
Guilty as charged.
yeah, Taildex takes a long time to rally, um, even when here we go. Let me see. Even when things look really bad, like we really worry that the world's going to fall apart. Even then, people are not rushing to buy these deep out of the money puts until they essentially have to. And in the pit, when it came to buying options, we would always say, buy them when you can, not when you have to. But people just love to rush in and sell. Well, they wait until the absolute very last minute. That's when they buy tail decks, and they love to sell it very, very, very quickly. So that's the dynamic with tail decks now. And again, you can see the chart of the last 52 weeks. You can see December of last year, we had that spike up to 30. You can see how quickly it came back down. This year, when tariff turmoil was really driving the market, you can see how it spiked. You got well above 40, almost to 50, but you can also see how quickly traders punished it and sold it back down. So that's a dynamic that we see a lot of now. That's not uncommon at all. That sort of thing. I'm not certain. I don't think I would be rushing in to sell those deep out of the money puts just because it looks like the all clear has been signaled. I think what's going to happen is there's going to be a time when market has a really tough spell. Taildex finally peaks, and then it looks like things are settling down. People kind of come in and rush in and sell these Taildex puts, and then there'll be another leg higher in Taildex, and I think people are really going to get hurt when that happens. So, and one final thing about on this is we deconstruct skew again to understand what important elements of the option market are doing, and so you can understand what the option market is really doing. But if all you do is look at VIX and you think, well, VIX is lower on the day, so all options must be cheaper, at least from an implied volatility basis, that is just fundamentally wrong. We saw how call decks and put decks are diverging today. And that's an important consideration. And that happens much more frequently than you would think. So we've done the study going back to 2005. And on a close-to-close basis, call decks, out of the money call prices, and put decks, out of the money put prices, diverge more than 42% of all trading days from a close-to-close basis. 42% of all trading days, nearly half. Those are going in different directions. And that's insight that traders need to have. And again, this is constant moneyness, always exactly one standard deviation out of the money. So this is not a function of market movement at all. But that's interesting.
And so how would an S&P trader use that information?
Well, that's one of the reasons we calculate risk decks.
Okay.
Again, it's that relationship, and we would suggest that when risk-dex is low, you put on collars, or if you don't own the stock, you put on what would a call spread collar, that is buying a put, selling a call spread. That's when risk-dex is really low, that is puts are cheap. When risk-dex is really high, go the other way. Sell a cash secured put or a put spread if you don't want to have to buy the stock, and buy calls. And that's a great way to get bullish exposure. The only other thing that we would might throw into the mix is, again, a momentum indicator.
I guess to tell when the move is done or might be done.
Yeah, and that's, for example, that was really powerful in AMD when out of the money calls are historically very expensive and the stock is overbought, RSI above 70. That's a really compelling trade structure.
So you were mentioning the Bitcoin that you have, the
Yeah.
metrics.
Yeah.
Can you show us some of those numbers? Because
Sure.
that's kind of interesting too.
Yeah.
And you use IBIT, right?
Yeah. IBIT is the underlying that we use for Bitcoin. And Doc, here it is. Let me show this because this is really interesting. So this is Valdex. Whoops, that's Valdex on Bitcoin. So again, precisely at the money implied volatility. And this is really interesting. You can see a steady downtrend. So when IBIT options first started trading, Valdex was at about 60. It's at about 35 right now. In fact, if I look on my other screen, oh boy, 33.67. So you can see a very strong downtrend. Now, I would not sell it in the hole. I wouldn't sell it here. But if I could sell it at 40 right now on a defined risk basis, I probably would. So that's Valdex on Bitcoin. Our other measures have less history. And that's only because, let me see. This is really, risk-dex is interesting on Bitcoin. We had much less history. The real history doesn't start until April. But that's because that market, that IBIT option market, Doc, it was not very mature until about April. We didn't have the expirations we needed. We didn't have all the strike prices we needed. So
you couldn't get a valid sample. You couldn't get valid statistics.
Yeah, right. Often the strike prices listed didn't even go one standard deviation out of the money. So, and that's fine. I mean, that's, exchanges, options exchanges, they have to roll out strikes and expirations in a logical manner for new listings. So we're not blaming them, but this is really interesting. So ignore the left half of this chart, if you will, and pay attention only to the right half, starting in April when we got valid data. Now this is interesting. We've also been talking, Doc. We've been talking about this quite a bit in our weekly newsletter, which comes out on Saturdays. We've been talking about this phenomenon quite a bit too, because as Bitcoin starts to act more like a risk-on asset, so more like equities than a risk-off asset like either treasury bonds or gold, then we would expect risk-dex for Bitcoin to be much more similar to risk-dex for, say, the S&P or the NASDAQ. And so we've been suggesting in our newsletter to essentially get long risk-dex, that is, long put, short calls, delta neutral, and you can see how that's really worked out. You can see here that it's gone nowhere but up from about the 1.00 level. So, and we would expect that to continue. May not. I mean, it's had a heck of a run over the past week or so. So I'm not certain how much not certain how much more momentum we're going to have there, but that's a trade that we've really been paying attention to, and we've done really well with that. Again, and that's simply because we expect Bitcoin to act, the options for Bitcoin to act more like Bitcoin is a risk-on asset than a risk-off asset.
So a risk that's up there suggests that the puts are cheap.
No, as risk X gets higher, puts are getting more expensive.
More expensive, okay.
More expensive relative to calls. And again, risk X in Bitcoin is rising not because people are fearful, but in this situation, it's rising because it's becoming a risk-on asset, and so it needs to have an option regime that's much more similar to other risk-on assets.
So an option regime that will accommodate collars and that sort of thing.
Yeah, it's something that an option regime that makes puts more expensive than calls, and by a fair amount because people are interested in hedging that exposure.
Right.
So, and for example, here we go. Here is Ristex on one of the ultimate risk-off assets, and that is gold. Ristex on gold. So you would expect Ristex on gold to be below 1, that is, show some call skew, for the very simple reason that when gold gaps, it tends to gap higher. So assets that gap higher rather than lower, equity indexes tend to gap lower. Risk off assets like gold, crude oil to a certain degree, treasuries, when they gap, they're going to gap higher. And that's why you would expect to see Ristex below 1.00. That is, you would expect out of the money calls to be more expensive than out of the money puts.
Makes sense. Now let's show us what you have with QQQ, NASDAQ, that kind of thing, because a lot of people like to trade NASDAQ and QQQ, get a little extra beta in there. Sure. Alpha, hopefully, but beta,
Yeah. Let's see. Let's bring these
up. Oh. Let me just talk to the dog for a second. 1 minute, Con. We're going to go out for a walk soon.
So that is Ristex on the NASDAQ 100.
Let me put it up. Hold on.
And I'm not certain what happened here. I wonder if we had a hiccup and we missed a day's data. We'll have to. I'll have the guys check into that and replace that. But this is an interesting look at puts versus calls in the queue, and you can see the puts got very expensive relative to calls when just recently, coming off that just a little bit. Anytime Ristex in the NASDAQ 100 is at 4 or above, it's very high. That's very high. So, and that's probably something that people want to take advantage of in ways that we've discussed. So let's see if we can't. See if we can figure out what's average. Oh, no, we're not going to do that. It's going to take me forever to find that. Oh, here we go. So here are all the important metrics for the Q, for our indexes on the Q. So you can see the average for those and the important percentile levels. Now, one thing that is interesting to me is that risk dex on the Q is always cheaper, almost always cheaper than it is on the S&P. So risk dex is lower in the NASDAQ 100 than it is in the S&P. That's kind of striking. I think that's a relative value trade that smart traders are putting to use. Why is this the case? Why are puts in the NASDAQ 100 cheaper relative to those calls and in the S&P? I just think if you're long the NASDAQ 100, you're kind of you're
cowboy.
You're in it. Well, you're in it forever. I mean, you're just, you're committed. You're not really interested in hedging your downside. Not as interested in hedging your downside as somebody who owns the S&P for long-term beta sort of trade. They might be more interested in. They might be more interested in hedging downside.
And I would just say institutions, as we know, tend to be the S&P whatever product, and institutions are going to have much stricter risk parameters and all that sort of thing.
Yeah, and protection in the form of options in equity markets is always very expensive, but people are just more likely to buy it in the S&P given the nature of holders of the S&P.
So somebody made a comment about dispersion trading. Can you talk about that?
Well, there are lots of people there are lots of different meanings of dispersion. By dispersion, do you mean buying vol in each individual name and then selling vol in the index?
I'm going to guess that's what he means. That's kind of what us retail think about when we talking about dispersion trading.
Oh, here we go. I'm sorry. I see the question. I see A's asking the question.
Yeah.
Well, okay. So the classical definition of option dispersion trading is you buy vol in each of the names and you sell vol in the index.
Right.
And it's a very difficult trade to accomplish because you have a whole bunch of competing Greeks, and you don't want to be left with some stray Vega exposure that you're not aware of. You don't want to pay a whole bunch of theta to do the trade. But the thinking is that if a couple of names have really outsized moves, then you're going to make out. But that those moves will be muted as far as the index is concerned. It's a tough trade to execute well. It's very mathy, and at least in the S&P, you'll almost always find that people who are doing dispersion trading ignore the bottom 300 or 350 names in the index because they just don't have much impact. So, if you want to, he's asking, so NASDAQ vol and go long MAGA vol. Well, yeah, I mean that would be a dispersion trade.
That would be a variation, right?
Yeah.
Here I have a little dispersion index up for the folks to look at.
But we've been calculating Voldex on the NASDAQ 100 for a long time. So longer than Mag 7 has really been a thing. So let me see. Here we go. So, for example, see, we've been calculating.
Let me put you up there.
I thought we were calculating it much further back than that. So, Voldex below 20 on the NASDAQ 100 now is low, but it's not crazy low. And it's certainly not low given where we are in the calendar. But RiskDex is always, historically, RiskDex on the NASDAQ 100 is cheaper than it is for the S&P 500. And that, again, that's something to take advantage of.
Okay. Well, we're running to the end of the hour. Anybody have any final questions? We got an expert here. So where's the S&P going?
Well, that's the thing, Doc. Again, tweet your estimate of where the S&P index is going to close the week. Do that to us at nations_indexes. And whoever is closest at the end of the week on a percentage basis, I'll send them a signed copy of my crash book.
And I'm putting that in the... And can you tell us how to subscribe to the service you're going to be offering?
Sure. Nationsindexes.com. If you'll go there, you can sign up for our free weekly Volatility Insights newsletter. And you can also sign up for real-time values for all of the indexes we've described, as well as a bunch of educational material. We have a new our indexes course coming out very shortly. 7 different lessons describing not only all of our indexes, but also implied volatility, realized volatility, standard deviation, which is a critical element in option trading. And then we're going to have other educational materials there. We'll have tear sheets for all of our indexes, which will have much of this information. And then also additional video courses that we're going to create, including option basics and for subscribers, how to use our indexes, which will go more in depth into that AMD trade, sort of AMD trade that we talked about, where Caldex was very expensive on an historical basis and the stock was overbought. I mean, that's a great setup for an option trader. Yes, AE, we have a discount if you'll use the discount code DIVERGE, DIVERGE. You'll get a discount on your first 3 months, and that's valid until the end of the month. Yep.
Now, are you launching something else in September, or is it going to be a... What do you got? Well, I guess let me put it this way. What do you have in the hopper?
Yeah, we're right now the site's in beta. All of the indexes are available in real time, but the rest of the site's in beta. And as this month goes on, we'll be upgrading our charting. All of the charting will be upgrading our charting, as well as adding all of the educational material with a focus on our indexes and how to use them.
Okay, so an add-on, a tweak function.
Yeah.
Okay, cool. All right. Thanks a lot for coming. We really appreciate it. And, full disclosure, I follow his stuff. I follow his Twitter stuff. Sometimes in my weekend newsletter or whatever, I get his newsletter and I glean some insight or whatever, and I use it.
Good, Doc. Good. And market literate, thank you. Thanks for watching. And again, if you follow us on X or Twitter, my handle is Scott Nations, and company Twitter handle is nations_indexes. And again, Joe and his team on our research side will regularly put up interesting charts or that sort of thing.
Okay, so I put the Nations Index, and let me put yours in also. And I like the book Anxious Investor. I read that one. I thought that was really good.
Thank you.
It was a very, very easy read,
Yeah, and that was a lot of fun to write, Doc. Quickly, it's we know that every human has a bunch of behavioral biases, and they really come out in stark relief when it comes to investing and trading. And unfortunately, none of your behavioral biases will help you as an investor. They all hurt. So the anxious investor, using some really fun historical anecdotes, discusses about 14 or 15 important behavioral biases that every investor and trader runs up against. A lot of fun to write. Again, none of the biases make you a better investor. They all hurt your returns. And there's some research describing just how much they hurt your returns. Fidelity, a couple of years ago, said that behavioral biases hurt the returns of the average investor by 150 basis points every year. And so the anxious investor highlights all those biases, and the goal is to also help you understand how to avoid them. So thanks so much.
Okay, thank you. And as a psychologist, I'm doubly interested in that, a retired psychologist. Okay, anyway, thanks again, Scott. And we appreciate it. And follow Scott and Nations Index on Twitter, and keep an eye open for his service. And definitely sign up for the newsletter. I use it all the time. And thanks again.
Thanks, Doc.